Palantir is up 126% year to date, but in the last month, it's down about 12%. So the question a lot of people are asking is it the right time to buy? Are you buying it on a temporary dip or not? In this video, guys, we're gonna go over bull and bear cases for Palantir, some high-level metrics about the company, analyst estimates, of course, our 8-pillar process, but we're gonna finish it off with what you're probably wondering the most about is what price should you pay for Palantir stock? Now, in this video, we're gonna have things for beginners and things for more advanced investors and everything in between. So no matter where you are on that spectrum, there's something in this video for you. So please stay with us the entire time. I guarantee you'll learn more, you'll understand more, and there will be things that are confusing. That's okay. They were confusing for me, and they were confusing for over the 200,000 people who subscribe to our channel. But the more you listen to it, the more you'll understand. And the more you understand and learn, the less you will fear. And that is our goal here, to teach that process so that money doesn't become fearful anymore, to make you more powerful in your investing journey. All right, so let's go over this. Palantir is a basically a $30 billion market cap business, which means if you buy all the shares outstanding in the market and you want to own 100% of the shares out there, you're gonna pay about $30.7 billion. But Mo, check this out. Their enterprise value is $28.5 billion. Guys, it's rare to see enterprise value less than market cap.
Very.
So what's enterprise value? It's taking all that market cap and adding on the debt, but taking off all the cash. So this shows they have a lot of cash on hand. It's hard for companies to go under when they have practically no debt or net cash. That's awesome for Palantir, a big plus for Palantir, right?
Yeah.
Some other things though. Net income isn't there yet. However, their free cash flow, you showed $48 million in loss in the last year, Mo, but free cash flow of $375 million. That's incredible. Oh, not good, it's great. Mo, their average 5-year net income is negative 460, but their free cash flow is only negative 6.8 million. They're showing more cash flow than net income. I love that. Usually it's the other way around because it's easier to manipulate net income than it is to manipulate free cash flow. So this is a definite positive and definite plus for Palantir. Great stuff here, okay? But again, guys, no profit yet showing, but they have a huge gross margin.
Massive.
Mo, Microsoft 68%. Palantir is 79%. This means every single dollar they bring in, extra dollar they bring in revenue, 79% of it goes to the bottom line to pay their taxes and move on. That's incredible. That's a big number, guys. That means if they're able to double their income tomorrow, almost 80% of that money is gonna go to the bottom line. That is awesome, okay? No dividend, really bad return on invested capital because they're growing so much. So I'm not worried about this. Not worried about this at all. So it's gonna skew some of the numbers. But remember, Palantir is still a fast-growing business. And when they're growing, they're reinvesting a lot of money, so it can make the numbers look worse than it actually is. Mo, what are some bull and bear cases for Palantir, and even some news for Palantir?
Yeah, some news. So they're new. They're a new kid on the block, kind of. They're entering into a partnership with Azul Energy to help them manage their 200,000 barrels of daily oil production. Target is to get to 250,000 a day. So,
and that's what Palantir's goal is. That's what their business model is. They take data from companies and countries and use it to solve their problems.
They renewed a partnership with WestTrac for 5 years. WestTrac is one of the largest Caterpillar dealers in the world.
Oh, really?
Yeah.
By the way, it costs a lot of money to become like a John Deere and Caterpillar dealer.
I remember you were telling me about those numbers.
Big numbers. Wow.
So they launched this is a bull case. They launched an artificial intelligence platform, which allows language models to operate within the enterprise space with privately held data. They have 100 new customers.
Oh, wow.
And that's over 3 months, and they're likely to add 300 more.
Now, my guess is, one of the things I remember reading in their annual report or quarterly report was they're trying to get smaller customers to expand their revenue growth. So before, they were focused on less number of customers, but higher revenue numbers. And that's great. But again, if there's such a high margin business, it's okay to get smaller customers and just really drive that revenue and profit.
So this one is not really bull case, bear case, and something we talk about all the time. 3 consecutive quarters of GAAP profitability with earnings per share of 1 cent.
So we're a little concerned about this guy. If you go back to our past videos on Palantir, they conveniently beat by 1%, and the way they beat, if you look at the notes, was very fishy.
Yeah.
That kind of bothered us a little bit about Palantir.
Right. Right.
Also, their CEO's hairdo kind of bothers me a lot too. Wouldn't you say?
More or less than the 1 cent. All right, let's do a couple
Are we online bullying right now?
bear cases, probably.
Some bear cases. Let's go.
So the full amount of their government contracts is $1.7 billion, and there's no guarantee that the government will exercise those contracts.
Yeah,
they
there's
only
a lot
go
of
1 year out.
Yeah, there's a lot of outs that the government has in those things.
Yep. So they only exercise contracts 1 year in advance. Promising more than a year is not guaranteed.
So you know what's funny? I was watching Shark Tank last night with Lisa,
Yeah.
and one of the things we were looking at was like the Costco deals that people do.
Yeah.
Costco can return the last 15% of inventory you send them. There's all these caveats in their deals,
wow.
and then people are like, "I want to be in Costco because they want to drive sales," but then the margin's lower. Then they have all these caveats. It's kind of a tough one there. It kind of seems like that's the way it is with the government.
Last bear case here. The most recent 10K, which was December of 2022, total deal value for commercial customers was down 23% year over year.
Yeah, but again, as I said before, they've talked about how they want to get smaller customers and smaller contracts to grow their revenue.
Yeah.
Is that an excuse for why it's so hard to get big? Maybe.
So you guys throw your bull and bear cases in the comments, and
Because we're missing something.
or do you think these are even like
Yeah.
I look at the 3 quarters in a row of the profitability, I just go, that's not a bull case.
Yeah.
But
I
it's a
don't
bull
care.
case on the websites we looked at.
So yes, like Mo said, comment below on what other bull and bear cases you have in there. When next time we do a Palantir video, we will go back, look at the best comments, and give you a shout out. So it'll get you a little internet fame by us commenting on what you are. And by the way, if you're a member of our community, put what your community member name is so we can bring that out too. All right, so let's look at the 8 pillars for Palantir. Now guys, remember, if you have our software, you can customize your pillars up to 12 of them of your own choosing. And there's like 4 quadrillion different variations. But Mo, this is a 3 check mark business. And the 3 checks are the things you'd expect in a fast growing startup. And the X's are exactly what you expect in a fast growing startup.
Absolutely.
So I am not even paying attention to this.
No.
I don't even care.
It's not helpful.
I don't think it's helpful at all. All I care about right now is what is their potential in the future. I will say this. The only thing that bothers me, I should take that back. This really bothers me. Shares outstanding. They're diluting the heck out of the owners in the company. They are bringing more and more partners onto you. So if the company grows 100%, they keep issuing more shares, you're not going to get that same growth. You're going to get a much lower number.
Common for a small company, though.
Very common. But they have cash flow now. They have a good balance sheet. They shouldn't be diluting anymore. And let's go see how they've diluted
quarter to quarter.
Quarter to quarter. So we go to our income statement. At the very bottom, it shows shares outstanding. So they're still diluting, but it's definitely decreased. But 20 million shares here and there, why, guys? Why are you doing that? Let's see what analysts are saying on the analyst estimates. So analysts are expecting, this is actually surprising me, Mo. Analysts are expecting 22 cents per share in profit this year and 48 cents in 5 years.
I expected a heck of a lot more.
4 years? Yeah, I expected way more. Even Tim said, wow. Guys, I was expecting it to be like $2 here in December 2027. That kind of bothers me. Yeah. Maybe it's part of the whole smaller contracts thing.
Right. It's true. There's a lot of unknown, too.
Well, here's what bothers me. Look at their revenue growth.
Contracts.
Look at the revenue growth. I would expected, with this kind of revenue growth, I'd expect the profit to be way more with 79% gross margin. That means 80% of their revenue that they grow, 80% of it will go to the bottom line. When they do this much revenue growth, it should be 4 or 5x their profit easily.
Yeah.
That's kind of a red flag for me. That kind of bothers me.
Okay. I'm surprised how few analysts there are. For a company of this stature.
Yeah, that's true. A lot of publicity. Now, guys, in our past videos, we talked about how we were interested in Tesla Palantir, when it was at $40, $45 a share. We said, be careful. I'm interested at 5. People were like, you're crazy. Well, what was the 52-week low on Palantir?
Was it in the 5s?
It was $5.84.
Interesting.
I didn't buy any because it didn't hit my price. And I'm still worried about the way in which they report profit.
And yeah, by the way, even though it got to the price point of, I would be comfortable purchasing, I still couldn't get there.
I know.
Couldn't
it was
get
tough.
There. Yeah.
So guys, it leads to the last question. What price should you pay for Palantir stock? And that's why we have our stock analyzer tool, which has been used over 2 million times by our users in the last couple of years. Guys, if you liked our tool here, if you like all of our software, if you like the 2 tools on the screen right here that you're talking to, sign up for the software, everythingmoney.com. You get all of this. You get all of our tools. You get all the software we're adding. We're adding so much data. You get the community of members. You get all of this for about $1 per day. This is a great way in which you can decrease your stress about money. It's super important. Check it out, everythingmoney.com. We have a 20% off going right now. It'll allow you to get in at a low price and stay with us. So guys, everythingmoney.com, check it out. So Mo, give me your revenue growth assumptions for the next 10 years on Palantir.
How about 12, 18, and 24? I think that's higher than analysts on the high side.
It probably is, but that's okay. 24% a year for 10 years takes about 9 times more in revenue. So it's about a $20 billion revenue business at that point. That's going to be hard compared to where they're going to be in 5 years, but we'll see.
Right.
We wanted the high number to be a really, really high assumption because we want to sit there and say, hey, is the current price of $14, $15 a reasonable price today? Okay. What about the profit margin, Mo? Because we don't have profit margin yet.
I know. This is a hard one.
Keep in mind, though, they've generated 18.4% in free cash flow margin in the last year.
Yeah. I was thinking 10, 20, and 30.
Let's do it.
And
guys,
the tough part about this is we're going to get our numbers and it's going to assume profitability right now.
Yes,
today.
So that's the hard part. I'm going to focus my value on Palantir based on free cash flow because they don't have the profit margin yet, probably because of all their deductions having to do with money, things like that, and also how they have to recognize revenue as it comes in. So as an example, a lot of times a publicly traded company, especially in software, let's say they sell a $10 million contract. Maybe $5 million comes in. That's cash flow. But they can't report that as income yet until they've released some of the software to the people. Yeah. So it might be $5 million in cash flow, but nothing in income. And that's the problem. So just keep that in mind going forward. Free cash flow margin, Mo.
What do you think about 15, 25, 35?
I love it. I think 35 is high, but I'm okay with that.
Yeah.
Now, PE. This is a hard one for this company because when it comes to PE, we believe in starting at the market average of 15, but go higher if there's a high return on invested capital, a lot of growth, and a moat. In this situation, there's a lot of growth potential for this company. So I think it deserves a premium. Because if two companies are exactly the same revenue, same profit, but one can grow 20% a year and one can grow 5%, which one will you pay more money for? Of course, the one growing at 20% per year. So Mo, what PE you're going to put on this company?
15, 20, 25.
Love it. Same with free cash flow, price of free cash flow? Great.
Yes.
Now, here's the big one. Desired annual return. Guys, remember, you can get 9 or 10% by investing in a low-cost ETF. So in order to buy an individual company, you should want to make more depending on the company. A company like this with a lot of volatility and still pretty young in its revenue and profit cycle, there's a lot more risk involved. And as we make higher and higher assumptions, you need more and more margin of safety because the high assumptions are less likely to occur. So Mo, low, middle, and high desired annual return for this company.
I actually put 15, 20, and 25.
Now, a lot of people are going to disagree with them. I don't. Because I still think it's such a young company with a lot of other risks that even if it hits at low end, I want to make a good return here.
Yeah, this is a riskier investment than any other one I would
Absolutely.
Make.
So I know there's going to be a lot of comments below on our assumptions about this company. And that's great.
Yep.
And that's the art of investing. You're going to have different opinions. Now, guys, I'm going to hit the analyze button. I want you to do me a favor. Stay with us for a minute or two longer. That's all I'm asking. Listen to our comments about these assumptions. Okay? Analyze. Scroll down. So here's the scary part. 175 to 260, even on our best assumptions, we're only at 850 or 10. And guess what? We're still in the $5 range for our middle assumption. So things have not gotten that much better, but here's the key, guys. If you pay today's price and the low assumptions occur, you're going to lose about 5.7%. If the middle assumptions occur, you're going to make about 7.7. And if the highest assumptions occur, you're going to make about 20% return. So even though they're red, it's because of the returns that we were acquiring. So guys, I look at this, it's just a little too tough for me at this price. They could absolutely crush it and go even further up. Awesome for them. But I do believe you got to be a little careful when it comes to a company like this.
Funny thing was, even at $5.84, it was still a little too tough for me.
I think it was for me too.
I think it's just too hard pile.
Yeah. So guys, everythingmoney.com, sign up for our software. It's a no-brainer. It's about $1 a day. You get everything here. Take care.